Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, and thank you for joining us today. My name is Marco Iacchini, and I'm a cross-asset strategist at Standard Chartered Bank. We are recording this on Friday, the 29th of January, and we have just released our latest global market outlook titled More Greed Than Fear. Now, since we published the 2021 outlook, risky assets have performed strongly, particularly led by equities. The Georgia runoff elections gave Biden Democratic control of Congress and provided tailwinds to environmentally friendly assets. To discuss what this all means today with us, I have Fook Yap, our senior equity strategist, and Audrey Go, our senior cross-asset strategist. Fook, let's start with you. As I mentioned, much has happened since we published the 2021 outlook, and equities have performed strongly. What developments are we seeing, and what is the team focusing on?
Yeah, thanks, Marco. Yes, the year has actually started very well for equities, so that has been good for our call. We were positive, and the year has started very well for equities globally, actually. But this week, we saw the U.S. equities, especially the S&P 500, had a bit of a wobble. It was down on Wednesday and then bounced back on Thursday. So volatility is up. It went up to as high as 37%. This is the highest since October. So this is a measure of the short-term risk of volatility in the market, and we saw that go up. Now, this pullback was anticipated given the crowded positions in equity markets, but we do see the pullback as healthy after the sharp rally that we've seen since the U.S. elections in November. So we would view the deeper pullback as an opportunity to average into our preferred themes.
All right, thank you, Fook. Now, since we're talking about pullbacks, right, what kind of technical levels are we watching? What can we offer our investors, our clients? What levels can we show them in terms of how to make these calls actionable?
Yeah. So in the global market outlook that we published, we do reference some equity market sentiment indicators there. So in there, we talk about the short-term indicators, and 2 out of 6 are arguing that equity markets may be stretched. And so these are indicating that there could be more pullback. So the one we could highlight is the put-call ratio, which signals extreme greed right now in the market. And typically, when you see a signal at the extreme level like this, the returns in the following months have generally been poor. And we're also seeing the narrative now of intensifying COVID-19 lockdowns, virus mutations, or delays in the vaccine rollout. There could be tax hikes as well that we're looking at in the U.S., and then the bond yields going higher. So there's a bit of a narrative going around with the stretch positioning that could argue for pullbacks. So in terms of the technical levels that we are watching, the mid-January low for the S&P 500 of 3750 would be a key level to watch. And 3750, if that breaks, the next support is at 3588, which is 4% lower, and followed by a much stronger support at 3341, which is 11% lower. So these are the levels we're watching.
Thank you, Fook. Those are actually very helpful. And one more question, if I can add. We're talking about levels, we're talking about adding on pullbacks, but specifically, what reasons do you see for investors to do so?
Yeah, so the Outlook 2021 that we published, we were actually positive on equities and risk assets. And we think that little has changed actually on the 5 factors that were driving our outlook for 2021. So number one, most governments still expect a significant population will be vaccinated by Q2 and Q3 this year. So mutations of the virus are a risk, but so far the vaccine plans have not altered and they are proceeding. Although a little bit slow, but we think that it will still progress, and that is positive. Of course, the stimulus measures from central banks and government policy is also supportive. We've heard Jay Powell speak, and the market was fearing tapering, but we're seeing no signs of tapering now. And that means the U.S. bond yields, while they've gone up a little bit, we think they will still remain capped because of the stimulus monetary policies. And the yields being capped will also argue for a weak US dollar, which will help emerging market assets especially. And all these support a global growth recovery, which will also support the value style equities. So in terms of the investment implications in equities, we do expect most regions to do well. The emerging markets will benefit from US dollar weakness. The US will benefit from the accommodative monetary policy and also earnings growth that we are seeing. And the value style that investors are favoring, that will support the Euro area and Japan equities. And on the bond side, we prefer emerging market bonds, both the US dollar and local currency EM bonds. Also, we like Asia bonds and the high yield bonds.
Perfect. Thank you, Hien. That was a very comprehensive overview. If we can shift gears and move over to Audrey, I want to talk about one of the key points that I mentioned in the brief intro, and that is Biden's presidency. What has become his focus, or what is his focus, especially within the first 100 days of his administration?
Thanks, Marco. President Biden entered the White House inheriting the U.S. economy in one of its worst conditions in recent years. Certainly very high unemployment today. More than 20 million people are still receiving some form of unemployment benefits. And of course, COVID-19. It is still ravaging in many parts of the country, and the president is certainly under pressure to take swift policy actions to tame the pandemic and also to help sustain the economic recovery. In terms of his initial plan, he has basically laid out this $1.9 trillion worth of fiscal stimulus for his first 100 days in office. He is also targeting to vaccinate 150 million people, and that's up from the prior 100 million people target for the first 100 days. And at the same time, also going to look set to reverse several of Trump's era's rules with the aim of building a sustainable green economy as they rebuild and stimulate the economy. Certainly, any success in Biden's goal will be a significant positive for reflating economies and also supporting risk asset equity markets, as we have laid out in our Outlook 2021.
Thank you, Audrey. So, since you talk about the success of the Biden administration, can you maybe elaborate a little bit more on what the success looks like and how can he achieve so?
Okay, he currently has a slim majority in the Senate, which will certainly give his administration some advantage in passing legislation. In fact, other than using the Senate itself, since entering the White House, Biden has in fact made good use of executive orders to tackle the pandemic. So if you look at the number of executive orders he has made so far, it is in excess of 40 orders. That is much higher than the prior 3 presidents in their first 100 days of the office. And about half of his orders are actually focused on pandemic-related responses, and another third are reversing his predecessors' policies. Now, if you look at his $1.9 trillion worth of stimulus, which is termed American Rescue Plan, this proposal will actually lead to an estimated fiscal thrust of around 8.6% of U.S. GDP. Certainly, we do not expect the entire proposal to be passed in its entirety, but even if we were to assume a pessimistic scenario of a 50% reduction in plan, this will still put overall U.S. response to approximately 20% of GDP since the beginning of the pandemic, which will certainly go a long way to sustaining and driving economic recovery going forward.
Understand. Thank you, Audrey. One last point before we conclude our podcast. We've seen it in markets, we've seen it in the headlines, and as we know, Biden's agenda is very focused on the impact of climate and climate change. What do you think are the implications here, and what are the implications specifically for markets?
Okay, so climate change has been one of Biden's top priority. In fact, on his day one of assuming the presidency, he basically recommitted to the Paris Climate Agreement, and he has also revoked construction permits on Keystone Oil Pipeline as well. And at the same time, he has also issued numerous executive orders to review and reinstate the more than 100 over environmental regulations that were weakened or even rolled back by the prior Trump administrations. In terms of investment implications, if we look at some of the listed climate-related investment that we track, clean energy equities, for example, has certainly delivered pretty strong outsized return so far since the elections. And flows into climate products has also been pretty robust. So going forward, we expect that to potentially become more nouns. For example, with more specific focus on energy storage and efficiency, smart grid, or even clean energy, for example, are some of the emerging focus that the market may be looking at. And certainly our thematic investment ideas also benefited quite significantly from this shift towards a green agenda by the administration.
Perfect. Thank you, Audrey, for your response. That concludes our podcast today. So thank you, Audrey, and thank you, Hien, for taking part in today's discussion. And thank you all for listening into today's podcast. Please stay safe and do reach out to your relationship manager or check the Standard Chartered Private Bank app if you would like a copy of our Global Market Outlook.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.